Okay, questions? Reflections, ruminations? Yes.
You talking previously about gold. I wanted to know what sustains and now today what actually sustains the price of gold. If you think about it, there are more things that we use, more practical things like water, for example, that we all need that I think should be more valuable than gold, but for some reason gold is so valuable.
Right, because gold is historically been viewed as a valuable medium of exchange and a valuable store of value. What do I mean by a store of value? I mean that which maintains its value more than other things during a time of price instability. Gold is trusted by everyone for industrial purposes. People trust gold because they know that if they have gold in an emergency, they can always use it for buying the essentials of life. And what has made the price of gold rise so much, it's been rising now above, what, $1,500 an ounce, if I remember the last thing I saw a couple of days ago. It's the fact that people have fear of inflation, that the value of this is going to go down in the future, that no matter how many of these you have in your pocket, it's going to cost you more and more of them to buy the essentials of everyday life. So what they've been doing is they've been hedging against inflation by investing in gold. And this has been occurring worldwide, which means that people are concerned about inflation in the United States, people are concerned about inflation in China, in Japan, in the European Union, etc. It's people basically saying that we have decreased confidence in the value and stability of the paper money. So we're shifting into something that we're hedging against as more likely to maintain its value and have marketability if the inflations get worse. That's what's pushing it up. It's basically people saying we don't have confidence in our government's paper monies.
You were explaining the business cycle and on the production possibility frontier curve.
Right.
And we were talking about the central bank reading the curve and the bubble. Can it be said that in the banks failing, the too big to fail, did the central bank or the Fed, you call it central bank, I'll call it the Fed, did the Fed read the system incorrectly, causing a lot of the banks to went into to close?
The problems that the banks got into, if I understand your question correctly, the problems that the banks got into, in fact, was fostered and induced by Federal Reserve policy. They made so much money available through this monetary expansion. For example, between 2003 and 2008, according to the Federal Reserve's own statistics, they increased the money supply, normally measured by a thing called M2. They increased the money supply in the U.S. by almost 50% in a 5-year period. The banks were so awash in money for lending purposes that the statistics also show that when adjusted for inflation, real interest rates, right, minus the effect of inflation on the value of the loan, real interest rates were either 0 or negative. So imagine that you take out a loan and you promise to pay 2% on it, okay? But when you pay back the principal and the interest, what the principal and interest are now worth are only equal to what the principal that you borrow. The lender gets no interest back. Or another way of thinking of it, I borrow $100 from you, and I promise to pay you $102 a year from now. But in real buying power, when I pay it back, it's worth $98. So the real interest was 0, was negative. You see, that's what was happening. So the banks were awash in money. Now, you lower the rate of interest rates were real low, and you're trying to get the money out because what are you going to do with it? That's, you have to do something with the money, you just extend loans. Now, the rates of interest are so low that you really can't push them much further to attract customers into the banks. So now what do you do to try to attract customers? You lower your creditworthy standards. Think of the mortgage market in the U.S., for example, which spilled over into so many other places. Oh, you don't have a down payment on the house? Don't worry, no down payment mortgage. Oh, you have a lousy credit history, right? You didn't pay back a loan, you were behind on a loan, you have unstable work history in terms of income to pay back loans. Don't worry about it, we don't care. Just shovel the money out. And that's what fostered all of this unstable and unsustainable lending. But the bottom line was, however uncautiously the banks may have, I'll even say irresponsibly, may have acted in lowering their credit standards to just get people qualified to take a loan, they wouldn't have done that, nor could they have had the motivation to do it if the Federal Reserve hadn't increased the money supply so much that they had reserves in the banks that they didn't know what to do with the money, so just get it out somehow. And that's what generated. Now, the other things were, as an addendum to this, is that there's two agencies in the United States that were set up by the government. The initials are Fannie Mae and Freddie Mac. These were meant to be agencies to foster loans for low-income people. And these agencies would say to the banks, lower your credit standards and make the loan to Joe and his family. Normally, given their credit history, their income-debt ratio, they really wouldn't seem to be, viable to have a home loan of that type. But give it to them anyway. And we, these government agencies, guarantee the loan. So if the loan goes bad, we'll make good on it. Or if you're still too nervous, once you've issued the mortgage to them, sell it to us, and we'll hold it in our portfolio of this government agency. Well, that was stimulating this irresponsible lending even further. And that's basically the nutshell of how this got totally out of hand and the housing market came crashing down. Oh, yes. Did you?
Yeah, I was saying, wasn't that through, wasn't the private banking less regulated under the Bush administration than it would have been under, let's say, a bigger government?
The most highly regulated sector of the U.S. economy is the banking industry.
Wasn't it less regulated?
No.
That's what I was saying.
No.
It was more regulated at that point.
It was the same, in essence, it was the same degree of regulation as before.
Okay.
But what was happening is the regulatory agencies were either supporting this expansionary policy or turning a blind eye.
Oh, they were turning